Welcome to the Small Axe Podcast. It's your boy Nico, the multifamily family man. We are going to talk about everything regarding multifamily real estate investing. Stick with me. This podcast episode is going to be epic. All right. What's up, everybody? Welcome back to another episode of the Small Axe Podcast. Today, I want to talk about something that's happening in multifamily right now that I think is incredibly important, especially if you are a small operator like me, or if you own a handful of properties, or if you're just trying to get into your first multifamily deal, and that is rent growth. For years, one of the biggest stories in multifamily was how quickly rents were increasing. In a lot of markets, you could buy a building, renovate some units, push rents very aggressively, and a rising market would help carry you along. Kind of like wind at your back, my fam. And honestly, it was really great while it lasted. But the data today is telling us that we are in a really different environment than that 5-6 years ago at this point. So according to Yardi Matrix, the average advertised rent nationally was $1,763 in June. But the more important number is that rents were up only 0.2% year over year. So basically flat. And obviously, this is a national average. So there are going to be swings depending on the market, right? It's market to market. But rents are basically flat. During the entire first half of 2026, rent grew about 1%. Now, historically, before the pandemic, you would expect something closer to 2.7, 3% rent growth. So anywhere from 2 to 3% rent growth during that same period was average and was normal. This was before 2020. So we're not just seeing slower rent growth, we're seeing rent growth that is considerably below historical norms. But as you guys know, there is likely a reason for it, and there is. So there is still a tremendous amount of new apartment supply working its way through the system. So about almost 1.3 million rental units nationally are currently in lease up, and Yardi expects roughly 478,000 multifamily units to be completed in 2026. Now, if you're listening to this and you're trying to buy your first 5-8 unit building, you might be thinking, all right, this is interesting stuff here, but what the hell does 1.3 million apartments nationally have to do with the 8-unit building that I'm trying to buy here in Lakeland, Florida, or Ohio, or Pennsylvania, whatever market you're looking at, maybe Atlanta, Georgia, who knows? But this is what I really want to touch on today, you, and how I can help you understand what you should be doing right now. So what do we actually do with this information is the real question. If you are a smaller operator or even just looking to get involved in the game still, you're probably not competing directly against some of the 400 unit luxury apartments out there. Okay. You're not a developer. You're not at the stage where you're looking at all different classes or alternative investments, like maybe storage units, mobile homes, RV parks. And you're definitely not chasing A-class 100 plus unit buildings. It's just not what's happening if you're just starting out, or you're joining a team that's already doing that. And that's a different story. So again, you're probably not competing directly against some of those bigger unit luxury development complexes, but you are competing for the same renters' money. And that's important because renters are going to go where the value is and where their dollar is going to extend them the most value. That's something that I think people underestimate. So imagine you're asking $1,500 for a 2-bedroom apartment in an older building. That's what I'm trying to push. But there's a brand new development nearby asking only $1,700. Or maybe they have concessions that are giving them 2 months for free, and still $1,700 is going to way demolish your $1,500 asking price. So on paper, you might think, yeah, great, I'm $200 cheaper than that brand new development, but they're offering 6 weeks free, 2 months free. They have a gym, they have a pool, they have everything is brand new. Maybe they're waiving an application fee or giving somebody a move-in special. Suddenly now, your $1,500 apartment in a C-class neighborhood with a 1970s construction is not competing against that $1,700 anymore. And this is why you have to know your competition, not nationally necessarily, not even necessarily across the entire city that you're looking at, but where you're actually operating, where that property is directly, who's across the street, who's a block away, who's within that same zip code, or even tighter, who's within that same tract as you. Who are you competing against? If you have a vacant unit right now, go to Zillow or apartments.com, rent.com, wherever people in your market are actually looking for apartments. Pretend you're a tenant, put in the bedroom count, price range, and location of your apartment, and what comes up, that's your competition. That's one way to do it. Find those listings, look at the pictures, look at the finishes, look at their rent, and look at their concessions. Okay. You might have to be offering concessions too. Sometimes concessions don't work, and I've found that out myself. But also, then look at how long those listings have been sitting. The, if they've been sitting for a long time, you're going to see bigger concessions and price decreases. This is just what happens. Supply and demand, basic balancing act. That little exercise is probably more valuable to you as a small landlord than knowing what the national average rent is, right? Because that 1,780 figure that I was discussing is not necessarily relevant to you directly where you're operating, okay? So stop pricing your apartments based on what you want. This is something that I'm dealing with in my own portfolio as well. So I'm speaking from experience, I'm speaking from passion, I'm speaking from the pain of trying to raise rents in a market that just won't support it. Now, as owners, we have a tendency to get attached to a number and we need this number. Yeah, we might need it for a refi, but do you really need it for a refi? Because there are other ways to push that. You can potentially reduce expenses, which is crazy, and I will get into in a little bit. Maybe your property manager is telling you that you should rent the unit for 1,400. Maybe your underwriting says 1,400. Maybe the previous tenant was paying 1,350 and you renovated. So you're thinking I should definitely get 1,400 or 1,450 even now. Okay. But then you listed at 1,450, let's say 1,400 even, nobody rents it. A month goes by. You decrease it to 1,400. Another month goes by. What are you doing? You're losing all this money. At some point, the market is giving you that answer. Okay. And I think one of the biggest mistakes that small operators like myself can make in this environment is refusing to listen to the market, refusing to listen to that answer, to adjust, to pivot. If it's vacant at $1,400 for 2 months, that's $2,800 of lost rent. Now imagine you could have rented it almost immediately at $1,350. Okay, you gave up 75 or more per month. Over the course of 12 months, that is close to $1,000, is $900, which is significant. But just recall that if you were vacant for 2 months, you just lost $2,800 trying to make an extra $900. And it actually gets worse than that because your vacant apartment may still have utilities to pay. Maybe you're paying someone to check on it. Maybe there's landscaping that still has to be done and you're paying for all this. There's additional maintenance. Maybe there's something crazy like a leak in another apartment that then affected this apartment and you're not getting any income on it. There's also the risk associated with having a vacant unit. So the true cost of vacancy is way more than just the rent that you're not collecting. You have to know that. And this is why I've become much more interested in occupancy and velocity these days. How quickly are we getting these units ready? Number one, how quickly are we listing them? How quickly are we adjusting if the market is not responding? Because every single day matters. So if you're not getting traction at 1,450, drop it 1,400, drop it again a week later, 1,350. Test the market. Call everybody in that neighborhood to see what they're charging. Why are people not renting your apartment? You cannot have vacancy in today's operational day and age. You just can't do it. You're going to get crushed. It is really important today to capture the market, to capture those tenants that are out there looking for an apartment, okay? Capture the good paying residents that are going to pay, okay, at a cheaper price. It's fine. You have to capture the market. With all the absorption happening, all the units that came online, if you don't capture the market, somebody else will. And they're giving huge concessions to do so, reduced rent to do so. Don't fall behind the curve. With all this quote unquote negativity that I just spilled on you, small operators actually have an advantage here. And I think this is encouraging. If you are a small operator, you can potentially move quickly. If you own a 10-unit property and 1 unit becomes vacant, you could look at the market today and make a decision right away. Maybe you dropped around $50. Maybe you offer a small concession. Maybe you improve the pictures. Maybe you repaint something, replace an ugly appliance. Change property managers, even if you have to. Maybe you personally go walk the units and realize, oh crap, I wouldn't rent this myself either. And that's the advantage. If you are a small operator, you don't necessarily need a corporate meeting involving 6 departments to change the price of one apartment. but you actually have to use that advantage. And that means that you need to be involved today. You need to be in the weeds. You need to be in the trenches. You need to be in the front line. You can't just hand your property over to a property management company and check your bank account once a month. You need to ask questions. You need to be on calls and communicate very frequently with your property management team, especially if you are not in that market as a boots on the ground. You want to ask things like, how many inquiries did we get last week? How many showings? What was the feedback? What are comparable units renting for? Are competitors offering concessions? How long have we been listed for? If you're getting a lot of inquiries, but nobody's applying, maybe there's something wrong with the unit. So you need to ask the tenants, what's the feedback like? Is it too small? Is it a weird layout? Does it smell funky? These things matter, guys. So these are things that you can do and you can change quickly and easily to get the upper hand in today's environment. And here's something else, guys. In my opinion, it is actually more important to retain good paying residents. And this is something that a lot of small operators need to pay much more attention to. It is your existing tenants. Let's say you have a good tenant who's paying $1,300 and the market rent might be $1,375. It's tempting to say, hey, we're $75 under market right now. Let's raise it, guys. What do you think? Will you re-sign, release with us? Maybe. But before you do that, run the entire calculation. Think about it. What happens if that tenant leaves? Maybe you've got a month of vacancy or 2 months of vacancy, $2,000 for a unit turn. That is a lot of money that you're going to be losing. Suddenly, you might be spending $3,000 or even $4,000 just to capture another $75 a rent. How long does it take to earn that money back? That's the calculation. I'm not saying don't increase that rent, okay? You're going to ultimately have to make that decision yourself. Stop looking at rent in isolation, okay? A good tenant has extreme value. Lower turnover has real value. Predictable collections has real value. And in an environment like today, a flat rent environment, those things can become even more important than increasing $50, $100 even. So be careful, pay attention. Now let's talk to the people who don't own anything yet. So if you don't own a single apartment complex yet, we'll talk commercial multifamily, 5 units or more. I don't want you listening to this episode thinking, well, I missed multifamily. It's all over. It's all downhill from here. I can never get involved. That's not true. I don't think you missed anything, actually. If anything, I think this environment could create real opportunities for people just like you. But you just have to underwrite a little bit differently. So 5 years ago, somebody might have shown you a deal and said, current rents are $1,200 and market rents are $1,400. We're going to renovate everything, increase rents, and then we're going to assume 4% rent growth year over year after that. Maybe that worked. It did for a couple of years. I know that it worked. Today, though, I would just be a little bit more skeptical. So if I'm buying a building where the current rents are $1,200 and somebody tells me the market rent is $1,400, I want proof. Show me the comps, show me the recently signed leases, not listings. Show me that those recently signed listings are paying. How long have they been paying for? What was the credit check on those tenants? I want to see those leases because I can list an apartment for whatever I want, but that doesn't mean that anybody is going to pay it. And then I'm going to ask another question. Does the deal still work if rents do not grow at all? They stay $1,200 for the next 2 years. That's crucial. That's a very different way of underwriting. I don't want to go in there and renovate anything today, as a matter of fact. I want to leave everything as is. Don't touch the rents. Leave them as is and assume no rent growth for 2 to 3 years. And if you're going to assume rent growth, well, that's just an upside case. Don't make that the norm. I would also run a scenario where occupancy drops. I would run a scenario where insurance is a bit higher than expected. Then I would ask, can I still make these debt payments or am I going to have to come out of pocket? Which sucks, by the way. Can I still maintain reserves, which is crucial for your success, or you're going to dip into your own pocket? Can I still operate the property properly? Can I survive? If the answer is no, then this is not the deal that you want, guys. Pass on the deal. I don't care if you pass on 200 deals after underwriting every single one for 2 hours each. I don't care. It is more important to pass on a bad deal, okay? Pass. Find the deal that works. It might take you a couple of years, and that's okay. Keep looking. You'll get one. So remember, guys, I don't want you to let a broker's pro forma mess up your underwriting or your business plan. That is not your business plan. You have to develop your own business plan. It is especially important for newer investors. So you're going to receive offering memorandums where everything looks beautiful. Rents are going to go up. Occupancy goes up, expenses somehow behave themselves and decrease. What? Hell no. But they're going to say NOI is going up, property values going up, and 5 years later, you are super rich, bro. That's what their spreadsheet says. That's a broker's pro forma. But remember what a pro forma is in general. A pro forma, by definition, is an assumption. We don't know the future. Your job as the buyer is to challenge every assumption. If the broker says that the rent is going from 1,200 to 1,400, ask why and how and show me proof, boy or girl. If they're projecting 3% rent growth, change it to 0. See if the deal still works. If they're using 5% vacancy, try 10, 12. Increase the insurance, increase repairs, increase payroll. Stress that deal, guys. You're not trying to convince yourself to buy the building. You're trying to convince yourself to not buy it. Why do you need this building? And if the deal keeps surviving after everything you throw at it, then hey, you probably found something worth making an offer on. But this way of thinking is going to give you a different mindset. And all of this is hopefully giving you guys a different way to look at and analyze deals today, which we have to. We have to pivot from the way we used to look at deals only 5 years ago. Times have changed significantly, and it's not a bad thing. It just means that we also have to pivot today. So the biggest opportunity may be better operations. And I've been saying this for months now because this is where I'm at in my investing journey. And I feel that this is where the conversation actually is going to become a little bit more interesting. If rent growth isn't going to save us, where does growth come from? Operations. Maybe you can't increase rent $100, $200. Can you reduce turnover maybe? Can you get vacant units ready in 10 days instead of 15, 20 days? Can you improve collections? Can you renegotiate some of the contracts that you have? Can you lower maintenance costs without lowering quality? Can you retain more of your good tenants? Can you make the property attractive without spending $15,000 per unit? I do it. Can you improve communication with residents? Can you price units faster and more accurately? Those things are going to move the needle. It's not sexy. It's not cool. It's not like, yeah, bro. It's not a vibe. Nobody posts on Instagram saying, hey, we reduced the average unit turn time by 10 days. Nobody cares about that. It's not aura, bro. It's not a vibe, bro. But that might make you more money than some giant renovation plan. And you need to know that. And this is something that I've learned more and more over the past months and even years. The building is not the business. Operating that building is the business. If you're listening right now and you already own multifamily, here's what I would do. I would pull up every vacant unit that I have. How long has it been vacant for? How long did the turn take? How long has it been listed? How many inquiries? How many showings? What are the 3 closest comps asking for? What concessions are my competitors offering? And when was the last time you adjusted your price? Then look at every lease expiring over the next coming 90 days. Which tenants do we absolutely want to keep? Which ones are paying on time? Which units would be expensive to turn? What rent increase actually makes financial sense when you factor in the risk of turnover, which could be $2,000 to $5,000? Then look at your underwriting. If you own a property that you bought 2 or 3 years ago, compare what you projected to what actually happened. Did rent hit your numbers? Did insurance? Did taxes? What about repairs? What about maintenance? What about occupancy? Where were you wrong? That's not an exercise in beating yourself up. That's how you become a better investor. And if you're trying to buy your first property, do the same thing with the deal you're analyzing. Take the broker's rent growth assumption and cut it. Take their vacancy assumption and increase it. Increase expenses. Then you will see if you still want the deal. So where do I think all this goes from here? None of this means that I think rents are never going to grow again, okay? Actually, there's a reason to be optimistic for the longer term. The massive construction pipeline is slowing down. That's a good thing. Yardy's forecast for 2026 completions is down significantly from 2025, and new construction starts have fallen. And eventually this matters. So if fewer apartments get built while the population continues to grow and people continue forming households, supply and demand begin to rebalance. And that's when existing owners could regain some pricing power for sure. But I don't know exactly when that's going to happen. Neither does anybody else. And that's really the point. I don't want to own a deal that requires me to predict the future correctly. I want to own a deal that can survive today, right now, under today's environment, today's lending environment, today's challenging renting environment. I want it to survive today. I don't want to own a deal that's going to require me to predict the future correctly. It's impossible, guys. I want to own a deal that can survive even if I'm a little wrong. Okay. If it can survive today for 5 years, because that's the typical loan timeline, you will be okay. But if you need rent growth to survive the next 5 years, don't do the deal. That's all I'm saying. So underwrite conservatively. Make sure you keep the good tenants. Get the vacant units turned as quickly as possible. Know your competition. Know what they're offering. Know their pricing. Know their concessions. Stay on top of your property manager. Protect your cash flow. Make sure you have reserves in the bank. And don't depend on that rent growth to fix a bad deal. There will always be good opportunities in multifamily. You just have to be able to find them. You have to be able to understand what they require for success and make sure that you're doing all that you can. I think the next generation of successful multifamily investors is going to look at things a little bit differently than the last one. And believe me, a lot of the quote unquote successful multifamily investors are out. Those that could not survive this downturn, those that only relied on rent growth might be out today. It's not going to be the person who can buy the fastest, but the person that can operate the best. And if you're a smaller operator, you should do exactly that. And it should excite you that this is your opportunity, because operating well doesn't require you to have $1 billion fund. It requires you to just pay attention and stay on top of things. Yeah, be disciplined. It requires you to know your numbers, know your competition, know the comps. It requires you to be willing to adapt when the market tells you that, hey, you're wrong, bro. And that's something that every one of us can do. So think of this as something positive. We got this. We can do this. I hope you got some value out of today's episode. And if you're trying to get involved in multifamily right now, don't let the data scare you away. Let it make you smarter and strategically better. And if you already own buildings, take a look at your portfolio this week and ask yourself a simple question. Am I operating based on the market that I wish we still had, or the market we actually have today? And I will catch you guys on the next episode. Keep swinging that axe. Thank you so much for joining me today on the Small Axe Podcast. Your attention truly means the world to me. Please leave a rating and write a review. Also, share this episode with somebody that you think could get value from it. Remember, it only takes a small axe to build a lasting empire. So get out there and start building your own.